Saeed, there's a lot to discuss this Tuesday morning. Help us make sense of all of this. I want to pick it up at that Morgan Stanley note that Matt has brought to my attention this morning. Do you agree with Morgan Stanley that the tech-led sell-off is only halfway done?
Good morning, Henry. How are you? First of all, I think we're having a moment of realization now. This sell-off came after the quadruple glitching on Friday. There's a seasonality factor which is attached to equity selling off in the last 10 days of September usually. The other major issue, I think, is the realization slowly that the financials aren't going to have any quick recovery in the short term. And this is putting some pressure on the broad market, as you see. Especially, it was triggered probably by HSBC's story and the FinCEN story. But I think what we're seeing right now is basically some money being taken off the table pre-election. As we approach elections in the next 6 weeks, I think that there'll be more of this happening. I'm not particularly sure that this is going to be a buy on dip market, but rather I would agree that we are now consolidating into a lower range in the S&P and the broad market.
Say good morning to you. Part of the debate is about the scale of this correction in the markets and whether we can debate this forever, whether a correction is healthy or unhealthy. But one thing which Robert Kaplan drew our attention to was the fact for him, credit spreads have not necessarily blown out, in his opinion. Yes, I know they moved higher. Yes, they're moving higher in Asia. When is it a red flag in high yield and IG for you if this equity market really begins to unpick?
Look, it's not really, I mean, saying credit hasn't moved significantly is not saying much, given that the Fed has backstopped credit for the interim since April. So there's really not much to look at credit. I think what we have to look at is basically the reflation trades that have taken place over the past 4 months. So if we're looking at oil, looking at gold, looking at these main barometers of growth, if we begin to see a sell-off in these markets, a consistent, not an event-led sell-off, but rather a reversal of trend, I think we can start looking at the growth story being reviewed. As we've seen over the past few months, the main beneficiaries of in the market have been growth-linked assets. So once we begin to see growth-linked assets begin to reverse, and inevitably credit will move, but not to the same degree, I think, as commodity-led assets. I think that's the main barometer. Keep an eye on commodities as a barometer of a reversal in the growth story.